In the first quarter of 2024, American companies spent more money on AI infrastructure than they spent on actual revenue growth. Let that settle for a second. We're not talking about research. We're talking about data centers, chips, server farms, physical buildings filled with machines that might never justify their own existence. And the money isn't coming from profits. It's coming from something much stranger. This is the story of who's actually inflating the AI bubble, how they're doing it, and why the math might be more absurd than you think. Right now, there are 7 companies carrying the entire weight of the American stock market: Apple, Microsoft, Google, Amazon, Meta, NVIDIA, and Tesla. Together, they represent about 30% of the S&P 500's total value. But here's what's weird. 5 of them are in an arms race that doesn't have a finish line. They're building AI, or more accurately, they're building the infrastructure to build AI. And every quarter, they report to investors with the same script. We're spending more than last year. We'll spend even more next year. Trust us. Microsoft announced in 2024 that it would spend $80 billion on AI-related capital expenditures. Google followed with $75 billion. Meta, a social media company that makes money from ads, said it would spend up to $65 billion. These aren't startups. These are profitable companies choosing to light their cash reserves on fire in a synchronized ritual. And Wall Street is cheering. The question isn't whether AI is real. It obviously is. The question is whether the current spending matches the current or even future revenue. And if it doesn't, who's covering the difference? Let's start with the smallest, most important piece: the chip. Every AI model that matters right now runs on GPUs, specifically NVIDIA GPUs. We're talking about the H100 and now the even more expensive Blackwell chips. Each one costs between $30,000 and $40,000. A single data center might need tens of thousands of them. NVIDIA's revenue went from $27 billion in 2022 to over $60 billion in 2024. The company added more market value in 1 year than most countries generate in GDP, and almost all of that growth came from one customer segment: big tech. Microsoft, Google, Meta, Amazon, they're not just buying chips, they're pre-ordering chips that don't exist yet. Multi-year contracts, billion-dollar deposits. NVIDIA has a backlog that stretches into 2026. Here's the first layer of the bubble. NVIDIA's valuation assumes demand will stay this high indefinitely. But the only reason demand is this high is because 5 companies are in an arms race with each other. They're not buying chips because they've figured out how to monetize AI. They're buying chips because they're terrified of falling behind. And the moment one of them blinks, the whole order book collapses. Now let's zoom out. Who's paying NVIDIA? The big cloud providers: Amazon Web Services, Microsoft Azure, Google Cloud. These companies are building massive data centers filled with NVIDIA chips and then renting access to startups, researchers, and enterprises who want to train AI models. Sounds reasonable, except the numbers don't add up. In 2024, Microsoft reportedly spent $50 billion building out AI infrastructure. But Azure's AI revenue, meaning what customers actually paid to use that infrastructure, was estimated at around $10 billion. That's an 80% gap. Google Cloud's AI revenue grew, sure, but it's still dwarfed by the capital expenditure required to generate it. So who's filling the gap? Investors. Specifically, public market investors who believe that eventually, someday, someone will figure out how to make this profitable at scale. But here's the kicker. The cloud providers aren't just selling AI compute to outsiders. They're also selling it to themselves. Microsoft uses Azure to run its own AI products. Google uses Google Cloud for Gemini. Meta built Llama and runs it on its own infrastructure. It's a closed loop.
They're spending money to build infrastructure, then using that infrastructure to build products that justify the spending, then reporting the internal usage as momentum, which keeps investors happy, which keeps the stock price high, which lets them raise more capital to spend even more. It's not fraud, it's just circular. The AI startup ecosystem is being propped up by the same companies that are buying the chips, building the data centers, and renting the compute. It's a vertical monopoly dressed up as an innovation economy. Here's the part where we do the math that nobody wants to do. Goldman Sachs published a report in mid-2024 estimating that the AI industry would need to generate $600 billion in annual revenue to justify the current level of investment. The problem, current AI revenue across all companies, all use cases, all verticals is estimated at around $100 billion. That's a 6-to-1 gap, and it's not closing quickly. Most AI products are experimental, subscribed at low prices, or given away for free to build market share. The companies making real money from AI, like NVIDIA, are making it from selling infrastructure, not from AI doing useful work in the economy. There's a term for this: capital misallocation. It's when an economy pours resources into a sector based on future expectations that don't materialize. It happened with railroads in the 1800s. It happened with fiber optics in the 1990s. It happened with housing in 2008. It doesn't mean the technology is fake. Railroads were real. The internet was real. Houses were real. It just means the investment got ahead of the demand, and when reality caught up, the money disappeared. So who's still playing along? Because the incentives are aligned in the short term. NVIDIA's stock is up. Microsoft's stock is up. Meta's stock is up. The executives get paid in stock. The investors make money on the way up. The analysts upgrade their price targets. The media writes breathless stories about the AI revolution. And no one wants to be the person who says stop. There's a quiet irony here. The companies building AI are using AI to justify building more AI. They're writing reports with language models about why language models are the future. They're generating marketing copy with GPT about why GPT-7 will change the world. The snake is eating its own tail and calling it growth. Meanwhile, actual use cases are modest. Coding assistants that save developers a few hours a week, chatbots that answer customer service questions slightly faster than humans, image generators that replace stock photo subscriptions. These are real, they're useful, but they're not $600 billion a year useful. The gap between the promise and the product has never been wider. Here's what makes this bubble different from past bubbles: the scale. The dot-com bubble was inflated by venture capital and day traders. The housing bubble was inflated by banks and mortgage lenders. The AI bubble is being inflated by the largest, most profitable companies in human history. They have balance sheets that can absorb years of losses. They have stock prices that can withstand skepticism. They have lobbyists, infrastructure, and control over the conversation where it happens. It's not a fragile bubble that pops overnight. It's a slow deflation that could take years. And during that deflation, the winners will be the companies that own the infrastructure. Because even if AI doesn't become the everything tool we were promised, it'll still exist, and someone will still need chips, data centers, and cloud compute. The question isn't whether the bubble will pop, it's whether it matters. So who's making the AI bubble so big? Not the startups, not the researchers, not even the hype men on Twitter. It's the same 5 companies buying from each other, investing in each other, and reporting to the same investors who benefit from keeping the story alive. The game isn't about AI, it's about capital. And right now, the capital is winning. The only question left is what happens when it stops.